You've probably heard it said that the most dangerous credit is the kind that never appears on a balance sheet. The riskiest loans aren't the ones you see, but the ones built in the shadows, engineered through structures with names that sound harmless, even sophisticated: direct lending, private debt funds, unitranche facilities, covenant-lite agreements. But if you listen closely, if you spend time in the quiet corners of the market where capital whispers instead of shouts, you start to realize something deeply unsettling. Private credit doesn't just lend money, it manufactures leverage. It doesn't happen loudly or openly. It happens in small, engineered increments that stack on top of each other, like hidden floors in a building no regulator ever mapped out. The whole system feels almost deliberate, as if the architecture of risk was designed to be invisible from the start. You can sense this when you talk to the people who operate in these circles, the fund managers who speak softly but with unshakable confidence, the lawyers who stitch together complex contracts with surgical precision, the investors who believe they've found a superior, untouchable source of yield. They all repeat the same reassuring lines. Private credit is safer than the old banking system. It's relationship-driven. It's covenant-protected. It's first lien. They emphasize their position at the front of the line if anything goes wrong. But what they don't say, what they can't say, is that private credit has grown so large, so interconnected, and so opaque that it now functions as a parallel credit creation machine. A machine with no central nervous system, no lender of last resort, and no circuit breakers to stop a catastrophe. All that exists is a sprawling network of private agreements, complex waterfalls, and layered tranches that expands leverage in ways the public will never see until it's already too late. If you were to walk into one of their offices, the atmosphere would tell you everything you need to know. There are no flashing terminals, no frantic traders yelling across a chaotic floor, just quiet rooms with thick carpets, where the only sound is a printer softly spitting out term sheets, like a steady, rhythmic metronome counting down to something unknown. But behind that calm, polished veneer, something is constantly compounding. A loan made here is used to fund a dividend recapitalization over there. A protective covenant in a contract is quietly loosened to keep a struggling asset alive on paper. A debt fund syndicates a small slice of its exposure to another fund, which itself is financed through lines of credit from yet another source. Each individual piece, when you look at it in isolation, seems perfectly stable and manageable. But the structure isn't built in isolation. It's built as a loop. The more you observe it, the clearer the pattern becomes. Private credit behaves like water inside a sealed chamber. It fills every empty space, every gap that regulated banks have stepped away from, every pocket of the market where the potential for yield looks a little too high and the oversight looks a little too slow. And just like water, it always flows downhill toward the path of least resistance, toward the weakest guardrails, and toward the easiest, most frictionless leverage. This illusion of safety isn't an accident. It's a core part of the mechanism. The silence surrounding it isn't a bug. It's part of the design. Most people assume the next major credit crisis will start in the places we're already watching: the big banks, the public bond market, or as a consequence of some major geopolitical shock. We're looking for a loud bang, but the truth may be much, much quieter. If you follow the incentives, if you follow the complex legal structures, if you follow the terms and conditions buried deep within documents that no one reads outside of a dimly lit conference room, you start to see something else forming. You see a loop that feeds on itself, a loop that amplifies itself, a loop that doesn't break until the underlying asset, the company it was meant to support, stops breathing. And when that happens, when the first major company misses its earnings forecast, when the first covenant waiver is denied, when the first payment waterfall breaks, the loop will suddenly turn on itself. It will start slowly at first, with a few tremors that most will dismiss. Then, will happen all at once. Because leverage, when it's built this way, doesn't announce that it's about to collapse. Private credit didn't just appear out of nowhere. It wasn't born as a shadow system, and it definitely wasn't the trillion-dollar force it is today. Its beginnings were much quieter, almost accidental. It grew not from a grand plan, but from a slow, steady erosion of banking regulations, of credit discipline, and of the lines that once separated big investors from the kinds of risks only banks dared to touch. To really understand this machine that now creates leverage in silence, we need to go back to a time when private credit wasn't even a phrase. A time when the idea of non-bank lenders directly financing corporations would have sounded like a weird experiment, a sign of a broken market, not a parallel system. But the seeds were already there, hidden in the cracks of a financial world trying to grow faster than its own rules would allow. Back in the 1980s and early 1990s, credit was a world ruled by banks. Commercial banks wrote the loans. Investment banks syndicated them, meaning they'd package them up and sell them off. Insurance companies bought the safest, investment-grade bonds. Pension funds mostly stayed out of the way, happy with their long-term, low-risk strategies. Everything and everyone had a place. There was a clear hierarchy, and leverage, the kind that really mattered, was all tracked right there on the banking system's balance sheets. But systems change when incentives change. And the first big shift for private credit came from a place you might not expect: regulation. When the U.S. government tightened capital requirements for banks in the late 80s and early 90s, something unexpected happened. Banks didn't just stop lending. Instead, they got creative about who did the lending for them. They started pushing more risk into special securitization structures, selling off loans, and using off-balance sheet vehicles. They learned how to slice loans into pieces and share the risk with investors who weren't banks. They didn't see it as creating a new market. They just saw it as a way to keep their business running under stricter rules. But every piece of risk that left the banking sector was also a piece of discipline that dissolved into the wider financial world. This fragmentation created an opening, a space for non-banks to step in. The 1990s saw the first wave of what we now call alternative lenders. These were small funds, specialist firms, and mezzanine financiers. They moved into the gaps that banks were leaving behind. They offered higher returns to investors willing to take on credit that was now too expensive for banks to hold under the new capital rules. These new lenders had no depositors to protect. They had no regulatory capital targets to meet. They had no systemic oversight to hold them back. The structure was small, sure, but it was nimble. It could go into corners of the market that banks could no longer justify. This was the first quiet stage of private credit, opportunistic, niche, and totally unthreatening. But even then, the DNA of the future leverage machine was already there. These lenders didn't just take on risk. They priced it using their own models and rules, without the external discipline that banks had built up over a century of experience. Then came the early 2000s. This was an era of cheap capital, rising leverage, and a widespread belief that financial engineering could solve anything. The big banks dominated the headlines, building enormous syndicated loan books, funding leveraged buyouts, and feeding the unstoppable demand for structured credit products. But behind the scenes, something else was quietly picking up speed. Big institutional investors' pensions, endowments, sovereign wealth funds were starting to look for higher yields again. Government bonds just weren't cutting it anymore. Public markets were becoming more volatile. And so, alternative assets became the magic words, promising something called uncorrelated returns. Suddenly, private credit, still small and relatively unknown, started to look very attractive. It seemed like a way to create returns without taking on what looked like market risk. But that word, visible, is key. The risk was there, it just wasn't as easy to see. Funds started to get bigger. Instead of small, $200 million mezzanine shops, you started seeing firms raising $1 billion, then $5 billion, then $20 billion for direct lending pools. Private equity sponsors absolutely loved this. Here was a source of debt that didn't require public disclosure, didn't swing with market sentiment, and didn't force borrowers to deal with the brutal world of syndication desks or ratings agencies. Borrowers loved it too. The terms were flexible, the process was smooth, and the relationship felt more like a partnership than a fight. But in every financial system, there's a moment where growth crosses a line and becomes something else entirely. For private credit, that moment arrived when large asset managers realized they could build lending platforms that looked and acted just like banks in every single way, except for one: regulation. When the global financial crisis hit in 2008, It didn't destroy private credit. It fed it. Banks were buried under a mountain of new rules, higher capital requirements, liquidity constraints, and a badly damaged reputation. They pulled back from many types of corporate lending. Whole sectors that once relied on bank loans, airports, logistics companies, manufacturers, energy projects, healthcare providers, found the door was quietly closing. They all needed financing, but banks were now slower, stricter, and lending less than before. Private credit stepped into this void with open arms. For the first time, these non-bank lenders weren't just filling in the cracks. They were replacing the old architecture. They weren't just offering risky mezzanine loans anymore. They were providing senior loans, unitranche loans, and complex credit facilities that combined multiple layers of risk into a single package. And because they weren't regulated like banks, they could move faster, lend more, and stretch credit further than ever before. This is where the hidden loop really began to form. The post-crisis world saw a huge expansion of direct lending, but it was never just about lending. It financed that loan by taking out its own credit lines with banks, repackaged the exposure into new vehicles for other institutional investors, and used the future cash flows from the loan as collateral to borrow even more. No single balance sheet captured the entire structure. The loop did. Throughout the 2010s, something massive was happening. Away from the glare of the stock market, private credit became the financial world's fastest growing star. The biggest players in this space transformed into giants, managing loan portfolios that would make a mid-sized bank blush. They built global teams, poaching top talent from investment banks and big-name funds. They became masters of the game, experts in crafting deals and lending money. But their most important skill, they mastered the art of being invisible. Every single loan was private. Every deal was negotiated behind closed doors. Every valuation was calculated using internal models, not by the public market. This entire system was engineered to keep information flowing to the insiders and away from everyone else. And this opacity, this lack of transparency, wasn't a bug, it was the main feature. Investors loved it. They poured money in, believing they were buying pure, unshakable stability. They thought private credit was safe from the wild swings of the market because the loans weren't constantly being repriced like public bonds. They believed that lending directly to companies was safer, creating a better partnership between the lender and the borrower. They bought into the dream of earning high returns without the usual risk, or what the pros call uncorrelated yield. But this belief overlooked a critical truth. Just because you can't see the volatility doesn't mean the risk isn't there. It just means you don't have visibility. Private credit was able to grow so fast precisely because it didn't have to flash its warning lights in real time. Unlike stocks or bonds, its valuations didn't fluctuate daily. Bad news was delayed. Losses didn't show up until a company actually defaulted or distributions to investors suddenly slowed down. This calm, smooth surface was a structural illusion, not a reflection of true strength. As the decade wore on, a new, powerful dynamic emerged. Private equity, the firms that buy and sell companies, and private credit were no longer just neighbors. They became partners in a self-reinforcing machine. Here's how it worked. Private equity firms needed to borrow a ton of money to make their deals profitable, and private credit funds were sitting on piles of cash, desperate for deals. They created a system where the company being bought, the firm lending the money, and the new owner were all tangled up together, sometimes even under the same corporate umbrella. Imagine this. A company is struggling with its debt. The lender, who also happens to have a stake in the company's success, simply agrees to look the other way and waive the rules. Or a private equity owner wants to pull cash out of a company they own. So, they have their own private credit arm lend the company more money, which is then paid out to them as a dividend. When your incentives are aligned like this, in the dark, transparency becomes the enemy. And in finance, when deals happen in the dark, you can bet that a mountain of debt is not far behind. With interest rates at historic lows through the 2010s and into the early 2020s, this machine went into overdrive. Investors, starved for decent returns, threw even more money at private credit funds. In turn, these funds started making bigger loans with fewer rules and protections. The quality of the companies they were lending to started to decline, But because of the built-in delays in reporting, there were no immediate consequences. Everything still looked perfectly fine on paper, but beneath all of this, another layer of complexity was being added, a quiet innovation that supercharged the entire system. Private credit funds started borrowing money themselves. They used financial tools like warehouse facilities, NAV loans, and subscription lines. This meant that for every $1 an investor gave them, they could lend out multiple dollars to companies. This wasn't just lending anymore, it was amplifying their own lending power. This created a hidden feedback loop. By the early 2020s, private credit was no longer some niche, alternative market. It had become a parallel financial system. It was a credit creation engine operating on the scale of the traditional banking sector, but without any of the same transparency or oversight. This created a huge paradox. The markets looked safer and calmer than ever on the surface, but underneath, they were more leveraged and interconnected than before. Think about it. You had companies depending on lenders, who were depending on their own lenders, who were all depending on financial models that assumed everything would remain stable. The whole system worked perfectly, as long as nothing broke. It all looked stable because the instability was delayed, deferred, and hidden from view. But history teaches us that systems built this way don't unwind gently. Credit booms never end with the first sign of trouble. They end when the illusion of control finally shatters. The first cracks don't appear in big news headlines. They show up in the fine print of loan documents, in surprise delays when investors try to get their money back, or when the funds themselves start facing pressure from their own lenders. The truth is, the seeds of the next crisis are often sown long before the public even starts asking questions. And as private credit continued its explosive growth, one uncomfortable fact became impossible to ignore. It had recreated leverage on a scale that nobody had properly measured. It did all this without ever showing up on the radar of the regulators whose job it is to prevent exactly this kind of risk from building up. Understanding this hidden loop is key to understanding modern finance. It's a story of how risk can grow silently, how leverage can be manufactured quietly, and how a lack of transparency isn't a flaw, but the very engine of expansion. What started as an alternative way to invest became a core part of the financial architecture. What started as an opportunity became a deliberate design. By the time regulators and the public finally realized just how massive private credit had become, the loop was already complete. And like all feedback loops in finance, it was designed to reinforce itself, growing bigger and bigger, until something, inevitably, stops it. The big twist in the story of private credit isn't what you think. It's not a dramatic crisis, or some high-profile company going bust. It doesn't look like the market freezes we've seen in the past. No, the real twist is much quieter, almost boring. It's a small fundamental shift that people on the inside saw happening long before most of us even heard the term private credit. It all starts at the moment when private credit stops being a lender of opportunity and becomes a lender of necessity. That's the pivot point. That's where everything changes. You can actually trace this change back to around 2018. Credit managers started noticing something strange. Companies and their private equity owners weren't coming to them just because private credit was faster or more flexible. They were showing up because they had nowhere else to go. The normal loan market was too slow. The high-yield bond market was too shaky. And the big banks? They were tied up with regulations and wouldn't touch certain deals, especially those with a lot of debt. But private credit funds would. And as soon as everyone realized this, the entire game changed. Private credit wasn't just competing with banks anymore. It was replacing them. This replacement had a quiet but massive consequence. The old rules of discipline started to disappear. In the traditional banking world, a borrower has to answer to a whole system. There are loan officers, credit committees, regulators, and ratings agencies. They all create friction. They slow things down. They say no. They demand paperwork, strict rules, collateral. But in private credit, those rules aren't set in stone. They're negotiated. Every rule can be bent. Every term can be customized. Every valuation can be interpreted. The very thing that was supposed to keep debt in check became flexible, something driven by incentives, not by strict oversight. This is when insiders felt the ground shift beneath them. They started whispering about a new dynamic. They saw companies surviving not because their business was getting better, but because their lenders couldn't afford to admit the investment was worth less. A company that a bank would have forced into restructuring could now just get a covenant holiday, a temporary pass on breaking the rules. A business that should have refinanced in the public market could be quietly rolled over by a private fund that didn't want to show a loss on its books. This wasn't some evil plan. It was just how the system was designed. When both the lender and the borrower need the company's valuation to stay stable, they enter into a relationship where the truth itself becomes negotiable. The plot thickens when you look at another quiet innovation: fund-level leverage. Back when private credit was small, funds just lent out the money their investors gave them. Simple enough. But as competition heated up and returns got squeezed, the funds themselves started borrowing money. They used subscription lines to lend money before their investors even sent it in. They used NAV loans to borrow against the value of their existing investments. They used warehousing facilities to build up huge loan portfolios before selling off pieces to others. Each of these tools made sense on its own, but together, they created something much more dangerous: a self-reinforcing feedback loop. You had leverage on top of leverage, all creating the illusion of stability. Insiders started seeing the pattern everywhere. They saw deals where a fund would lend to a company at an 8% yield, but that loan was financed with the fund's own borrowed money that cost 5%. Meanwhile, the fund's investors were getting steady quarterly payments that completely masked the rising risk in the portfolio. They saw companies taking on more and more debt, not because the business was booming, but because the lenders needed to show loan growth to attract more investors for their next big fund. They even saw these complicated structures where one fund would prop up a troubled company, while another fund from the same firm would finance the deal. On paper, the credit looked perfectly healthy, but it was only healthy because the system refused to let it look any other way. And this is the heart of the twist. Private credit has built a world where stress doesn't surface, it just accumulates. It's a world where defaults are delayed, losses are smoothed over, and valuations are protected until the very last possible second. What looks like resilience from the outside is often just inertia. Companies that should have been restructured were instead given more time. Businesses that should have downsized were instead given more cash. Funds that should have reported losses instead just negotiated waivers. And every time the truth was pushed down the road, the loop got tighter. The most telling sign of this shift wasn't in a chart or a news headline. It was in the language. People stopped talking about credit selection and started talking about capital solutions. Companies stopped asking for loans and started asking for flexibility. Private equity firms stopped trying to optimize capital structures and started trying to optimize optionality. These words sound sophisticated, maybe even harmless. But what they really mean is that the system is now supporting companies that simply couldn't survive under the old rules of lending. And the only reason it works is because all the signals that would normally flash red, the valuations, the broken covenants, are all controlled privately, behind closed doors. This is the twist that most people haven't understood yet. The very strengths of private credit, its flexibility, its privacy, its apparent stability, are also the foundations of its fragility. The system works precisely because it doesn't show cracks. It works because problems can be massaged, delayed, or restructured quietly. It works because there's no real-time market pressure forcing everyone to be disciplined. But just because you can't see the stress doesn't mean it isn't there. It just means the stress has no way to get out. Instead, it builds and builds deeper inside the system. And that's where the real danger is hiding. When the next real downturn comes, not the mild slowdowns we've had, but a genuine economic contraction, private credit will be forced to do the one thing it was designed to avoid: reveal itself. When companies can no longer pay their debts, when valuations can no longer be smoothed over, when all that fund-level leverage has to be paid back, the system will finally have to face a truth it has been postponing for more than a decade. And when that moment comes, it won't be a single default or a single failure. It will be the entire feedback loop breaking. It won't be loud, and it won't be public, at least not at first. But the moment it begins, Everything the system has kept hidden will start to surface all at once. When a private credit fund lends to a company, the rules aren't set in stone like they are in public markets. The terms are negotiated, shaped by what both the lender and the borrower want. The borrower wants flexibility to run their business. The lender wants steady cash flow and the appearance of low risk. This creates a strange dance. The lender might agree to rules or covenants that look protective but are full of loopholes. They might include creative adjustments and metrics that make it super easy for a borrower to look like they are in compliance, even when their business is actually struggling. This isn't necessarily deception. It's more like a strategic calibration. But these calibrations weaken the very guardrails that are supposed to signal when a company is in trouble. A classic example is how they define a company's earnings, or EBITDA. Instead of using standard accounting rules, these loan agreements often let companies add in things like expected cost savings or future synergies that might never actually happen. So, a company with declining performance can still look perfectly healthy on paper. Why would a lender allow this? Because it prevents a technical default, which would force them to mark down the value of their loan and admit there's a problem. This is the first quiet gear in the machine. Flexible terms create the illusion of health, which keeps the whole debt structure afloat. Now for the second layer, fund-level leverage. This is where simple lending starts to look more like complex financial engineering. Private credit funds don't just use their investors' money. They routinely borrow huge sums from banks, using their own portfolio of loans as collateral. These credit lines let them invest more money, faster, which can juice up their returns. But it also means that a single loan to a single company is now supporting multiple layers of debt. Imagine a fund lends $200 million to a company, but $80 million of that was borrowed from a bank. The bank is now watching the value of that underlying loan. If its value drops even a little, the bank might demand more collateral or restrict the fund from making new investments. This is a huge deal. The fund's risk isn't just about whether the borrower can repay the loan. It's also about the perceived value of that loan. In public markets, this perception changes every day with stock and bond prices. But in the private world, the value is determined by the fund's own internal models. And what do those models rely on? The very same adjusted, flexible metrics from the loan agreement. This creates the second powerful loop. The lender's own valuation of the borrower determines the lender's ability to borrow. This gives them a massive incentive to keep valuations high, even if the underlying business is weakening. The third layer is what I call risk recycling. This happens almost entirely behind closed doors. A private credit fund might sell off small pieces of its loans to other funds, insurance companies, or other big investors. But unlike in the public markets, this process is informal and private. There are no public price quotes, no official filings, no credit ratings. It's all done through quiet, negotiated deals between a very small circle of insiders. The effect is profound. Risk leaves one fund's balance sheet, but it doesn't just disappear into thin air. It moves to another private entity that might also be using leverage. And because the transfer happens in secret, it doesn't create the market signals like falling prices or rising interest rates that would normally warn everyone else that something is wrong. Instead, the system just circulates the risk among itself, keeping official valuation stable and hiding the volatility. This is the third stage of the loop. Risk is passed around instead of being recognized, which allows the system to keep chugging along even as the foundations get shakier. And that brings us to the fourth layer, portfolio interdependence. This is the glue that binds private credit, private equity, and structured finance together in a way that's incredibly difficult for anyone on the outside, including regulators, to track. Picture this. A private equity firm owns a company. That company needs a loan. The private equity firm might just steer that deal to its own in-house private credit fund. On paper, the loan terms might look strict, but in practice, they're incredibly flexible because both sides are part of the same family. If the company starts to struggle, the private equity owner just negotiates with the credit fund it also controls. They might agree to take on more debt to pay a dividend back to themselves. They might agree to a covenant holiday to avoid triggering a default that would hurt both the value of their equity and the value of their credit. This creates an incredibly powerful shared interest. Both the owner and the lender want to keep the company's valuation high, even if that valuation is no longer connected to economic reality. As long as both sides agree to keep up the appearance of stability, the system looks fine, but underneath it all is a deep structural weakness. The entire system becomes dependent on the continued willingness of these interconnected players to prop up companies that might otherwise be forced to restructure. When that support finally runs out, or becomes too expensive, the entire loop starts to groan under the pressure. Finally, please talk about the famous waterfall, the hierarchy that says who gets paid first when a borrower is in trouble. Private credit loves to sell itself as being at the very top of that waterfall. First lien, senior secured debt. But in reality, it's a lot messier. Many so-called first lien loans are actually complex structures with multiple layers hidden inside. You have unitranche loans, split structures, and special provisions that can blur the line between safe senior debt and riskier junior debt. These complicated structures allow lenders to extend far more credit than a company's cash flow can realistically support, while also letting them collect extra fees and even equity-like returns. The economic exposure becomes much larger than the official loan amount. So when a company gets into trouble, the waterfall doesn't work like a clean, orderly line. Instead, the private lenders start negotiating amongst themselves, behind the scenes. They might roll unpaid interest back into the loan, extend deadlines, or swap debt for a piece of the company. They might even agree to bring in new rescue financing that gets to jump the line and be paid back before them. It's a constant reshuffling of the deck, all happening away from public view. So, when you put it all together, you see that private credit isn't just a simple lending business. It's a complex, multi-layered machine designed to manufacture and manage leverage. From flexible covenants and internal valuations to risk recycling and deep interdependencies, each layer reinforces the others, creating an illusion of stability and low risk. In theory, it's a simple structure where senior lenders get paid first, protecting them from losses. But in private credit, this structure is surprisingly fluid. When a company gets into trouble, instead of letting losses flow down, lenders often renegotiate. They grant waivers and amend covenants. This keeps the borrower afloat and delays the recognition of a loss, but it also degrades the very protection the waterfall was meant to provide. What was once a hard rule becomes a matter of negotiation. Then there's valuation lag, one of the most important, yet least understood, features of private credit. In public markets, if a company is struggling, its bond prices fall in real time. Everyone sees it. But in private credit, there are no public prices. Valuations are done internally, usually once a quarter. These marks are based on models and management forecasts, not actual market trades. This creates a time delay. It allows a fund to report smooth, stable returns even when the underlying companies are facing headwinds. It's like driving by looking in the rearview mirror. You see where you've been and what the cliff you're heading towards. This lag is not just an accounting quirk. It's a core feature that allows leverage to build up silently. A fund might keep borrowing against outdated, optimistic valuations, and its investors continue to believe everything is fine, long after the economic reality has soured. Now, add another layer: how risk is spread out. Before 2008, banks packaged loans into complex securities and sold them off. Private credit does something different, but with a similar effect. It disperses exposure through a web of separate accounts, co-investor vehicles, and joint ventures. A single loan can be sliced up and held by dozens of different entities. None of them see the full picture, and none of them have the sole responsibility to sound the alarm when things go wrong. They're all connected, but indirectly, through shared valuations and intertwined financial structures. This creates a system where risk is everywhere and nowhere at the same time. And the complexity doesn't stop there. Many private credit funds use something called subscription lines. These are credit lines from banks that allow the fund to make investments before actually collecting the cash from their investors. It speeds things up and can boost returns, but it also means investors' committed capital is essentially collateral. If the fund's portfolio weakens and the bank gets nervous, it can pull that credit line. The fund would then be forced to make an emergency capital call, demanding cash from investors on short notice. This can create a sudden liquidity squeeze for the very investors who thought their money was safe, forcing the fund to sell assets at fire sale prices. On top of that, we have NAV loans. These are loans taken out by the fund itself, using its entire portfolio, its net asset value as collateral. The bank lending the money isn't looking at individual struggling companies. It's looking at the overall portfolio value. And because of that valuation lag we talked about, the portfolio can appear much healthier than it really is. This allows the fund to pile on more debt. But when the valuations are finally updated to reflect reality, the adjustment is often abrupt. The fund might suddenly face a margin call, forcing it to sell assets just to pay back the bank. A slow, creeping problem suddenly becomes a sharp, painful break. Then there's the illusion of diversification. A fund might boast that it holds hundreds of different loans, spreading the risk. But often, many of these companies are owned by the same few private equity sponsors, or they all operate in the same industry like healthcare or software. So, a downturn in one sector, or a problem at a single large sponsor, can trigger a cascade of defaults across what looked like a diversified portfolio. The connections are hidden, but they are powerful. So, you have all these mechanisms working together: flexible covenants, valuation lags, hidden leverage, and false diversification. They create a system that is incredibly good at one thing: keeping stress under wraps. It smooths out volatility and delays problems, maintaining an appearance of calm and stability. But what happens when the stress can no longer be contained? It unfolds in stages. First, the problems are internal. A company is struggling, and it quietly asks its lenders for a break. The lenders agree. Then, the fund's portfolio marks start to drift down, but only by a tiny amount, maybe 1 or 2%, not enough to cause alarm. Next, the banks providing leverage to the fund start getting a little nervous. They ask for more reports, more updates. After that, the fund itself starts feeling the pressure. It slows down new lending, and investor distributions might get delayed. Suddenly, the problems become too big to hide with accounting tricks. The borrower is in real trouble. This forces the fund to make a significant write-down on its value. And that's when the loop breaks. The banks pull their credit lines, investors panic, and a system designed to absorb shock suddenly amplifies it. Every financial system, in the end, reveals the truth it spent years trying to avoid. We imagine that collapses begin with a loud event, a sudden headline, a shocking default, a confession in a boardroom. But real failures never start with what you see. They start with what is hidden. And private credit, more than any other financial structure built in the last 2 decades, is a system built on a dangerous belief that risk can be managed by discretion, that losses can be postponed by negotiation, and that leverage can be tamed simply by avoiding daily price checks. The silence that once protected this market is the very same silence that will define the moment it breaks. The problem isn't just that private credit is growing at an incredible pace. It's not even that it has become a parallel banking system without ever calling itself one. The real danger is that everything inside it, the loan terms, the company valuations, the investor payouts, the quiet amendments to contracts, all depend on one critical assumption: that this closed loop can absorb stress forever. But loops aren't shock absorbers. They are amplifiers. They grow tighter as economic conditions worsen. And the tighter they become, the less room there is for the system to adjust when something finally snaps. The mechanism doesn't fail because it's flawed. It fails because it was designed to postpone truth, not to eliminate it. Most people won't see the early warning signs, because private credit is designed to hide them. There won't be screens flashing red or stock tickers collapsing in real time. There won't be traders shouting on a trading floor or liquidity vanishing in a blink. The first signals will be much quieter. A delayed payout here, an unexpected demand for more cash there, a loan amendment that feels a little too generous, a small adjustment to a company's valuation small enough to ignore. but just large enough to matter. These are the whispers behind the walls, the subtle disturbances in the structure. By the time the public senses that something is wrong, the insiders will have been living with these signals for months, maybe even years. When the economic cycle finally turns, and I mean really turns, it won't be the obviously troubled companies that reveal the shift. It will be the complex structures built to disguise that trouble. Subscription lines of credit, which funds use to borrow money quickly, will tighten. Lenders who provide financing based on a fund's net asset value will start asking questions they once ignored. Banks that provided credit facilities will quietly reduce their exposure. Funds that once moved swiftly to make deals will start to slow down. The entire system, built on the idea that private agreements can replace public price discovery, will discover its greatest vulnerability. There is no protocol for collective transparency. Think about it. A public bank knows exactly what to do when losses hit. A public market knows how to price them instantly. But private credit, by its very nature, has no ritual for revealing pain. Every fund has its own valuation model. Every lender has their own set of assumptions. Every private equity sponsor has their own incentives. When a company they've lent to starts to weaken, the decision to acknowledge that reality isn't systemic, it's negotiated behind closed doors. And when multiple parts of the system start negotiating at the same time, the loop breaks its own symmetry. Stress becomes visible, not because someone finally speaks up, but because no one can hold the silence anymore. The truth is simple and uncomfortable. Private credit's greatest advantage over the last decade, its ability to smooth over volatility, hide fluctuations, and delay recognizing losses, is the very same feature that will define its correction. When the losses finally surface, they won't appear one by one. They will surface simultaneously, because the entire system has been suppressing the same pressure for years. This pressure isn't malicious, it's structural. It is the hidden cost of building a financial architecture that prioritizes flexibility over transparency, discretionary valuations over market discipline, and private agreements over public signals. So the final warning is quiet, almost gentle. Do not mistake resilience for invisibility. A structure that hides stress is not safer than one that shows it. It is simply later in revealing what was always there. When the dust settles, the companies that survive will be those with real, tangible cash flow, not just creatively adjusted earnings. The funds that endure will be those with low leverage, not those that promise the highest returns. And the investors who successfully navigate this shift will be those who understood a fundamental rule. In a world built on negotiated truth, the only thing that cannot be negotiated is the moment the loop stops spinning. When that moment arrives, and it won't look like a spectacular crash. It will look like a series of small, seemingly isolated failures, scattered across dozens of borrowers and dozens of funds. But beneath those isolated events, the same pattern will be repeating itself over and over. Leverage that could no longer be hidden, valuations that could no longer be smoothed, and structures that could no longer absorb the weight placed upon them. The silence will break, not with a bang, but with a kind of soft, gradual unraveling, the sound of a loop returning to the point where it began, no longer able to sustain itself.